I believe that stocks and bonds, in many ways, are reflecting two different versions of reality, of economic reality. The bond market, with its persistent inversion, has been pricing in Fed rate cuts. But I believe that their rationale for doing so is that they foresee economic weakness ahead. Whether or not you can argue that the bond market has been, as predicted, I forgot the expression, but let's say 10 of the last 3 recessions or something of that nature. Bonds may be a bit pessimistic, but the reason for the inverted yield curve is Fed easing. Their rationale behind the yield curve is low inflation and the need for the Fed to ease because of a weak economy. Stocks, on the other hand, rally because they like the prospect of Fed rate cuts. The problem is, if the bond market is correct, it's going to be very difficult to get earnings growth or out of a market out of an economy that seems to be in decline. So somehow the stocks have taken it one step beyond the bond market to say, okay, there's some weakness that we see out there, but the Fed is going to come riding in on its white horse to the rescue and save everybody. Generally, what I've found over time is when stocks say one economic prediction and bonds make another economic prediction, the bond market tends to be right. It's not necessarily in a day, a week, but over long term, the bond market gets the economy usually more correct than the stock market. Why? Because there's less noise in the bond market. Basically, you're talking about flows of money and the cost of money and how inflation and then the economy affects inflation. It's a purer read, whereas stocks, you've got stories, you've got earnings, you've got themes and all these other things that go on, especially when you have a stock market right now that's driven by growth companies that for the most part are not really economically sensitive. And so that to me really strikes me as a mixed message. And we did get some clarity on Friday as to the messaging when the jobs numbers came out, and they were better than expected. The Fed funds futures market and other similar futures products, which were pricing in 100% likelihood of a Fed rate cut at the end of the month, Fed meeting, backed off from, let's say, saying 75% chance of a 25 basis point cut and 25% chance of a 50 basis point cut. Let me say that again because that's a bit confusing potentially. They basically said 100% chance of a rate cut. 75% of that chance would be that they would cut a quarter of a point. 25% chance would be that they would cut a half a point. After the numbers, that changed. The consensus still is that the Fed is going to cut rates, although very few people are now looking for a 50 basis point rate cut, and they're now basically saying there's an 80% chance of a 25 basis point cut. These numbers are fluid, but that's more or less the sentiment. You do have to wonder now what the Fed's going to do. I think you're seeing a growing thought that the Fed is going to basically say, here's your 25 basis point cut. This is all you're going to see. They can actually now say that they're data dependent, resume saying that they're data dependent because the data is in many ways more economically favorable than people thought. So there's a lot of moving parts here. But again, I think when you're seeing conflicting messages about the economy from the stock market and the bond market, and I do believe we're seeing that now, over time, I do think that the bond market tends to get it more right than the stock market.